For the next hour, you'll be leaving the Show Me state and entering the Show Me the Money state. So stop what you're doing, grab a pen, and get ready to learn. Randy and Jake Floyd of Floyd Financial Group will be your guides for straight talk and honest answers about living the life you deserve in retirement. So prepare to be empowered. Now, here are your Show Me the Money hosts, Randy Floyd, Jake Floyd, and Jeff Shade.
Thank you so much. Welcome to Show Me the Money with Randy and Jake Floyd, the radio show that gives you the straight talk and honest answers you need to help reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about the retirement playbook changing in 2026, also common retirement misconceptions, then common investing for retirement misconceptions, and then finally, what does a Floyd Financial Group retirement review actually look like? My name is Jeff Shade. As always, I'm just here to ask the questions, but the words of wisdom and solid advice, they come from Randy and Jake Floyd of Floyd Financial Group. Start with you, Randy. How you doing today?
Very well, Jeff. How about you?
I am doing well, thank you, for a Valentine's Day. Hey, Jake, how are you doing?
Doing great, Jeff. Thanks for asking.
Once again, guys, glad to hear that it is Valentine's Day. Randy, I think you said it was the most important holiday of the year for you. I think you said it tongue-in-cheek, though, right?
Yes. It's something that we do talk about and we celebrate, but we try to keep it in balance for sure.
Right. Well, I think it was one of those Hallmark holidays anyway that they made
Right.
up just to sell greeting cards, and people will be sending their mail to Loveland, Ohio, down near Cincinnati so that they can get them postmarked from there, too. Jake, anything special going on in your household today for Valentine's Day?
So we'll be heading down to Arkansas, actually. So I'll probably be celebrating Valentine's Day with my mother-in-law and my wife.
Okay.
But they're both allergic to roses, so we'll have to figure something else out there.
Lucky you. Isn't it funny how the price of roses goes up around Valentine's Day? I don't even know how much a dozen roses is these days. It's got to be over $100, right?
That's what they call dynamic pricing, Jeff. It is whatever people will pay.
It's like when a big concert gets out and you order an Uber and it's like 8 times what it normally is.
It's like surge pricing. I was thinking of that with the rideshare places. New Year's Eve, it's always the surge pricing, and it happens at Valentine's Day. Wait until February 15th or 16th, those roses will go back down about $1.25 each, something like that. Anyway, we hope everybody's having a great weekend. As always, we appreciate you joining us here for Show Me the Money. Randy, the headlines are basically saying these days retirement rules are changing. In plain English, what's different about 2026, do you think?
Well, let me be clear on something, Jeff. The retirement playbook is in constant flux and change. I mean, it's one of those things that, while yes, as we look back over our shoulder, I think traditionally people would think that, well, once I've retired and I've saved all my money and I've stored all my nuts up in the tree over there and buried all my money out in the Prince Albert cans in the backyard so that I know that nothing's going to happen to it. The set it and forget it mentality is way behind us, due partially to the fact that we basically today process information that used to take 5 years in one day is kind of what has happened. So everything is much faster and coming at us every day. Used to be when people got to retirement age, they'd throw their money in CDs or maybe in some bonds and they would collect their paycheck and get on down the road. Today, it's not always that easy. In fact, we've come through a period of time where it was really hard for bonds to be what it used to be as a good safe haven for long-term investors, simply because as interest rates go up, bonds got devalued. So that hurt quite a bit through there. But we're seeing a little bit of again, with the playbook always changing, we're seeing a little bit of that reversing now as interest rates have come down from that 5.25 down to about 3.75 at the Fed funds level. So retirement playbook changing. As always, it's just a different day with more speed.
Yeah, the times they are changing.
Little Bob Dylan there for you. Our Bob Dylan impersonator here, a tribute by Jake Floyd.
But anytime I hear somebody say the times are changing, I can't unhear that. Yeah.
So bonds aren't the safe saver that they used to be, Randy. Playbook for 2026 has got to include inflation. It is really stickier than people expected, isn't it?
Yeah, I think it is. And really, I think we are seeing the supply side of things start to firm up. The big problem we had stemming back 5 years ago, starting with COVID, was we printed a whole bunch of money and we sent everybody home. So there was nothing to buy, but everybody had all kinds of money. So anything that did come up for sale, people paid more money for it. We're kind of working through that whole scenario. I do think, though, that the supply side is coming back. And as we have more supply and as productivity increases, that tends to be good for pulling prices back down. We've also seen here of late that the price of oil is way down from where it's been, which also affects everything. Not only the fact that it moves, but many, many products are made with oil as a base to it. So there's a lot of good things coming down the road. Bonds are looking a little bit better now as interest rates have kind of settled in here a little bit. We actually have seen, too, with all of the wars and rumors of war and all the things going on around the world right now with all the political unrest everywhere, we have seen that bonds are actually attracting a few dollars now out of the market as people have gotten a little bit scared of the market a little more than they were. So are bonds coming back into a position where they could be useful in a retirement portfolio? Absolutely. The yields are pretty solid, and we're seeing a little bit of price appreciation as well.
Randy, we're almost 2 months into 2026, and I know it's maybe too early to tell, but what's your opinion on dividend income? Do you think it's going to come back in style here in 2026?
So, if we look back over our shoulder and we look back in the 80s and even the early 90s, the S&P 500 dividends were in the 3 to 4, maybe 4+%. Well, today, with all of the growth we've had due to all the printing of extra money that's in the system, our yield on the S&P 500 is probably around 1.2, I think, last time I looked. So dividend stocks as a whole, there's not as many as there used to be. There's a lot of growth stocks, and growth stocks, the way you make money there rather than collecting a dividend is those companies reinvest their money, continue to grow their business, and then hopefully the stock price goes up. So for you to realize a gain there, you've got to sell something to realize the gain. Versus in the past, when we had those strong dividend payouts, people could pretty much sit back and take a long time and watch it grow slowly and collect their, as Mr. Wonderful, what's his name?
Kevin O'Leary.
Kevin O'Leary.
Yep.
The mother's milk of investing is what he calls dividends, right? So
I believe that he believes that.
Yes.
yeah. So anyway, do dividend stocks have a place in a portfolio? Yes, but we don't do it simply because it pays a dividend. And again, the dividends in the S&P 500 are much lower than they used to be. So it's certainly not something that people are going to be able to survive on.
Talking with Randy and Jake Floyd, Floyd Financial Group. We're talking about the realities of the retirement landscape here in 2026. Again, our phone number, 417-889-7233. If you'd like to come and sit down, talk to Randy and Jake, get a retirement review, and talk about how maybe your retirement plan might shift here for 2026. No cost, no obligation, no judgment. 417-889-7233. So the old retirement playbook may not be working as well as it used to here in 2026, Randy. The old playbook was retire at 65, go 60-40, stock bond split, take 4% forever. Inflation's going to stay low, and bonds provide income and safety. The new reality is what?
Well, basically, we have to get over this inflation hump for sure. And we knew that it was out there, and we knew it was possible. We had it back in the late 70s and the early 80s for sure. You know what was funny about that, Jeff, is I remember I was working back through there, and did we have a lot of inflation? Yes, we did. 40 years ago, I was a pretty young lad at the time. I didn't know that there was inflation because I was too busy working.
Yeah, me too. I thought about that. How did that miss me that I was working at the same time? I didn't notice the inflation because, as you said, I was working.
Yeah, and I bought a house in 1987. I held it 8 years and made 40% on it too, you know, in the area that I lived on. So the new reality is, like I said, everything moves faster today. Markets are choppier. There's good news, bad news, same day, knee-jerk, reactive people out there. There's more people invested in the stock market today than there's ever been as a percentage of the population. Not that there's 100%, but there's more than ever. And a lot of those folks they're knee-jerk reactive. They hear something. We've talked about on here that emotion and money is never a good thing.
Right.
But removing the emotion from things that happen is something that you have to cultivate over a long period of time. Interest rates have moved. They move faster than ever. And here of late, I was watching to see how quickly banks would start to lower CD rates. And for the longest time, they kind of held out and they moved exactly with what the Fed funds rate was doing. But here of late, the last couple of days especially, I've been listening to people, and banks are now offering 2% CDs, while the Fed funds rate is still hanging out around 3.5 to 3.75. So it's kind of interesting. Banks realize that interest rates are coming down, and they don't want to get caught holding the bag.
Even though those same banks are talking about interest rates going higher and things, like, you have to understand, and I think this is important for our listeners to understand, is whether it's Glenn Beck or Brian Moynihan or any of your favorite talking heads on business news or any podcast that you may listen to, they all have their own axe to grind. And everything that comes out of their mouth is at least somewhat self-serving. So that doesn't necessarily make them wrong, but it does mean you have to really consider the source whenever you're taking advice from anybody. I think that goes 10 times today what it was 20 years ago. People are out to get you, whether that's a comfortable feeling or not. You have these banks saying that interest rates are going up when they know they're going to be coming down, and they're hedging them coming down way ahead of time, even though they don't have to. They don't want to get stuck holding the bag. They're afraid that more and more chairs are getting kicked out from under people. And and it is a very relevant situation.
Yeah, if they can lock in a 6% interest rate for a while rather than a 4 or a 5, they're going to do it.
Sure.
Where they're getting paid that much. Of course, they want to pay you less and earn more. The banking industry is based on the spread. What does it cost them to borrow money? And what do they get to sell it for, right? When they loan it to you.
3 words of advice: follow the money. There always is that motive, or at least most of the time. In 2026, I think one of the big buzzwords is diversification. And I saw a study that said 86% of high-risk retirees are failing a diversification test. How does something like that happen? And what does true diversification really look like here in 2026?
Yeah, so I'll tell you why it happens. Many times, especially looking over our shoulder, and for some local stocks here, Jack Henry, O'Reilly, a couple of them that we have right here. People were around, they worked for those companies when they were young and new companies, and they started investing there and they owned stock and then just got entrenched. And we see that in many cases, not as much as we used to, but maybe you worked for IBM for a lot of years. Maybe you worked for Kraft for a lot of years, and you have stock ownership programs and things like that. People get kind of rat-holed into those. The other thing is people are looking to maybe hit a home run, so they over-invest in something that they think is a sure thing and really going to work. And so you got to be careful there.
I also think, in my opinion, one of the biggest things that happens is what I like to call risk tolerance drift. So when things are really bad, people tend to get overly safe, and they're like, hey, I need to sell everything, and we need to buy really conservative investments. If you want to buy low and sell high, when things are really way down is when you actually want to get more aggressive. Conversely, when things have been really good for 3 or 4 years, everybody's like, hey, I have unlimited risk tolerance, and they stick their chest out and start pounding on their chest and say, I can handle it all. And then when the market gives us a situation like April of last year, they realize very quickly that they are not ready to handle all that risk. And so I think that risk tolerance drift both to the aggressive side and to the conservative side can account for a less diversified portfolio.
Yeah, I think that's a really good take on that, Jake. The other thing I would say, too, is many times when, especially we see this in 401ks and things, people go out and they look at their 401k options out there, which seems to me over the last few years, those 401ks, they have crunched down the number of investment alternatives that they used to have. Now, there are some that are offering more for an additional management fee today, but just the basic stuff out there, there might be 15 or 20, maybe 30 options total, and 10 of those are target date retirement funds, which are basically, again, we look back at the old 60-40 bond to equity portfolio type thing, but those things are kind of predestined to do some things, and they don't really always take into consideration what's going on in the world today. So when people go out and look at mutual funds, many times they don't get underneath the hood and really understand what it is they're buying, and therefore they think they're diversified because they own several different setups, but they may have 50 or 60% of that where it's the same investment over and over again. So sometimes that can be very misleading.
So the retirement playbook for 2026 is changing a little bit. And as far as tax rules and tax breaks go, there is some good news there. And that is that still we have higher contribution limits, which of course equals opportunity. Their catch-up contributions matter a lot for people 50 plus tax planning is becoming more valuable than stock picking. The big takeaway, retirement success isn't just returns, it's after-tax income. Randy and Jake, good conversation here. I want to take just a moment to talk to our listeners. If today's conversation hits home, you're sitting there thinking, I've saved well, but I'm not 100% sure my retirement plan is built for this economy, then this is exactly the moment to get some clarity. Because the truth is, the old retirement playbook doesn't work the same anymore. Inflation is still biting, bonds don't behave like they used to, and too many people are heading into retirement with a plan that looks good on paper but doesn't hold up when real life happens. That's why Randy and Jake here at Floyd Financial Group are offering a retirement review at no cost and no obligation to help you understand where you stand, what your biggest risks are, and what you can do right now to protect your income. So here's what you can do next. Call 417-889-7233. 417-889-7233 or visit floydfinancialgroup.com and ask for your retirement review. Don't guess on retirement, get a real plan. Okay, Randy and Jake, time for a break. When we come back, we're going to be talking about common retirement misconceptions when our program continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready for another helping of some more real money talk? Thought so. Now, here's another serving of Show Me the Money with your hosts, Randy and Jake Floyd, with Jeff Shade.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money, and in this segment, we're going to talk about common retirement misconceptions.
That's right, or otherwise known as myths. We are the Mythbusters here, and I don't know if you remember the old Mythbusters show on TV. The one guy wore sort of the beret hat. Jake, do you remember that show?
Yep, so his name is Jamie. And yes, I have probably watched with my son, I think, every episode of Mythbusters that has ever been released. He was really into that when he was 7 or 8, and he loved watching it. And I think the dynamic between the two of them, Adam and Jamie, it was always very good. Jamie was a lot more calculated. Adam was all over the place, but I think that show kind of tested everything they could possibly think of. And honestly, what really was, I think that kind of ended the show is the 3 younger people that had joined. So it was Grant and...
I can't remember what the girl's name.
There's a girl with the tattoos. I don't remember her
I can't remember her now, yeah. But they broke off and did another show called The White Rabbit Project, and they'd only got 1 season done on Netflix. And then Grant Imahara, who was one of the guys on there, he ended up dying. So that ended that show, and that was tough. So he was the one that did all the battle bots stuff back in the day, and created the robots that kill each other and all that kind of thing.
Well, I thought one of the greatest myths they busted on there was how easy it was to shoot fish in a barrel. And it wasn't easy. It turned out it was very hard to shoot
they
fish in a
couldn't hardly
barrel.
do it, yeah.
Really? Well, I'm surprised PETA wasn't picketing outside the store or wherever or something like that. Anyway, let's talk about retirement myths. I don't know who wants to wear the beret here, but we'll figure that out. Why do retirement myths become so dangerous, Randy and Jake, especially for high net worth families or actually even just everybody?
Yeah, I had this conversation with somebody yesterday, and it was not about retirement planning, but it was just about something else that they were talking to me about. And I said, but the interesting thing about that is I don't even know the right question to ask because I really don't know what it is that I don't know about that because I just know so little. And so in this country, we are not very good at educating people on money issues in general, right? So I think that's a lot of it is... And with the complexity of today's world, I mean, it's kind of like I was explaining the tax code to somebody about how it works with Roth IRAs versus traditional IRAs versus regular interest income versus capital gains. And they were like,
what?
Whoa, wait a minute, stop. And that's just one little section. Now, when we get into estate planning, which for wealthier clients is very important, how do we mitigate taxes and how do we realize what we want while we're alive, while not setting up our kids to pay a bunch of taxes down the road? All of those things that people just don't know, and you wouldn't, because that's why there's a whole area of expertise through attorneys, tax attorneys. They have a designation called LLM, which is basically they have a master's in taxation. We got attorneys that all they do is estate planning. It's just crazy, all the stuff that we have to know. So sometimes people don't realize what it is they don't know. Sometimes it's the fact that inflation has changed things so much. Maybe it's taxes, maybe it's healthcare. And sometimes it's just like, hey, I know it'll all work out. I'm not doing anything. Or you can be like this one guy that I know, he says, I'm just going to create a big mess when I die and let everything go through probate.
Well, probate's like filing a lawsuit against your kids anyway. That's another thing I remember that you said. Yeah. Well, let's talk about these myths. I want to present the first one to you and see whether it's myth or fact. I'll work as long as I want so I can choose exactly when I want to retire.
Well, we'd like to think that, wouldn't we? We don't always get to make those choices. We don't know when the next diagnosis or the next accident or what is going to happen. And none of us can ever know that.
Well, and today with the job cuts going on too, you can say, hey, I want to work 2 more years, and then your position gets eliminated, and then you're like, do I really want to go learn a new skill set?
Right.
Or will they even hire me in that new area because they know that you're a short timer at that point? There's a lot of things outside of your control. It's a little bit like the healthcare thing. I'll never let my mom go to a nursing home. Well, you may or may not have a choice at some point if you want her to be safe.
Right.
Many things in life that are outside of our control, and I think we know that, but we still have a tendency to get lulled to sleep and think, hey, I'm in charge of my own destiny.
Absolutely. And here's another thing to think about. Let's say that you did plan to retire at 70 and you have to retire early. Let's say you have to retire at 62. Well, that's 8 years of potential earnings on your retirement savings that you're not going to have. Now, here's what we know. The rule of 72 tells us, take 72 and divide it by our average return. So if our average return is 8, that means money doubles every 9 years. Well, here's the thing. If I'm 8 years out and I have to stop early, I could have nearly half as much money as I would have been counting on in my retirement years to pull money off of. And that's a huge difference. So this retirement plan is something that we need to really be mindful of all the way through. And from the time we get to about 55 and beyond, well, you need to be serious long before that, but we need to be really careful and really looking at our planning and watching what's going on and protecting our health as much as we can in those later years.
So I'll work as long as I want to. That myth, I think, is busted. Myth number 2, retirement's going to be like a permanent vacation with absolutely no financial worries.
I was watching this show on TV and it said, I'm just about as happy as my unhappiest child. I thought that was an interesting
That's an interesting thing to say.
A woman said that.
Yeah.
But, there's all sorts of factors that pull on us other than just how much cash flow we have, I think is the real point here. Several people that come in here that I know where they have lost their spouse, and for the last 5 years, they've been sitting at home doing nothing. And I see them slowly going down. Then I have others that have maintained relationships. They haven't lost a spouse or anything yet. They're much happier. There's just a lot of different things that come into play. I had a brother-in-law retired several years back, and his whole identity was his job. He was an orthodontist.
Right.
And once he was no longer an orthodontist, he was lost. So right away, he started having dementia problems and things like that. The other thing is, I have these ladies that say, hey, Randy, why don't you call my husband and take him to play golf? He's driving me crazy. We aren't used to spending 24/7 together.
Yeah.
There's all sorts of things that come up. Now, is retirement good? Yes, retirement is good. And can it really be great? Yes, it can if you've done great planning. So you can travel, you can realize what your hobbies are, and maybe have a second home if you want to. Not really on my bucket list because I don't want to have to go maintain it, right? But anyway,
Right.
I'll go rent a Verbo somewhere. But basically, there's a lot of things in retirement that you don't think about that come up when you actually get there that you hadn't thought about. I mean, if you go out to do anything, just build a house, mow a yard, take a bike ride, whatever it is in a new area, there's things you don't expect.
So retirement will be like a permanent vacation with no financial worries. Again, we have busted that myth. Myth number 3, I'll spend less money once I start working. What do you think about that one?
Well, I can tell you that hasn't been the case for me. But
No.
But I think what it amounts to is, yes, we have some expenses that go down. You don't pay Social Security, Medicare, Medicaid taxes anymore. So maybe you get a little bit of a tax break. Maybe you're not running up and down the road, or maybe you're not commuting back and forth. You're not making your retirement contributions. But now what happens is you have to fill the time that you used to be at work. Sometimes that costs money. Traveling, dining out, hobbies, healthcare, home projects, and things you just don't count on. So filling your time, I think, is probably one of the biggest ones. And unless you're doing volunteer work or church work or something like that, sometimes that comes with a price tag.
Exactly right. I've got a neighbor across the street, and he worked for the state for many, many years. And now he's spending more money than he used to in retirement because he converted his garage into a very fancy wood shop. And he bought all of the equipment. He's got all the wood, but he's having a great time out there too. So, hey, spending less money in retirement is another one of those myths that, of course, has been busted. Let's move on to our next myth here, guys. My relatives didn't live past their 70s, so I only need to plan for a very short retirement. What do you think about that one?
Well, genetics do have something to do with it. However, I will tell you, none of us know how long we're going to live. And one of the things today, we know we can keep people alive for a very long time where people would have used to have passed away.
Right.
And I often wonder, are we really doing ourselves any favors?
Well, yeah, I've often thought about that too. Do I want to be miserable because I'm being kept alive artificially at 95 when I know no one, all of my relatives and friends are dead? Or do I want to just let God do its work and pick the time?
Yeah. Well, there was one guy that said that guy had a heart attack and just died. How devastating. And the one guy said, well, he didn't spend any time in a nursing home.
Yeah, there's a positive to almost everything.
Yeah,
here.
So-
pluses and minuses.
Yeah, there's pluses and minuses to everything. And I often tell people, I want to live long and die short.
Yeah.
But I think the ultimate part of all this, though, is you don't get to choose, unfortunately.
I sometimes tell people, well, we're going to plan for you to have money till age 90 or 95. And they go, I'll never live that long. Well, tell that to the 95-year-old that came in to see me last week, and you certainly don't want to be out of money at 95.
Well, of course not. It's not like you can get another job at 95, working at McDonald's or anything like that, too. I mean, talk about age discrimination. By the way, I meant to say that age discrimination is alive and well. People who think, well, if I get fired from my job, we'll just find another one. If you're over 55, I think you're probably going to have a little bit of a hard time. So is it fair to say that we can bust that myth?
Absolutely.
Okay, let's move on to our next myth on the radio version of Mythbusters here as far as retirement goes. When the market gets volatile, I should move everything to cash.
Well, those people that did that, about 10 days ago are wishing they hadn't.
Yeah.
Because we saw that happen, right, Jeff? I mean, here we are. We ran up. We hit a new high in the S&P 500 of 7,002 points. Then we went back down to 6,700 and some change. And as of this past week, we were right back. I mean, we are nipping on the heels of 7K again on the S&P 500. And here's what happens. When people get knee-jerk reactive is what I call it. Now, there's times that it makes sense to trim and do things. But many, many times, we have to look for systemic reasons to do that. Not just somebody went off half-cocked on CNBC and everybody went, and so we went out and liquidated things. But the problem is, once you sell and you've watched the market go down and it turns around, the problem that people have is they go, okay, well, when do I get in? So they wait and they go, well, man, it looks like it's just going to keep going. And so they finally get back in, and now they got back in maybe toward the tail end of another run up. Now they're back out, and then they're saying to themselves, I will never, ever do that again. And they've missed the boat. They've just missed the boat. So it's important, yes, that we look at where our income's coming from. We rebalance our accounts from time to time. We have to do that because things are always changing. And part of that discipline is what we do here at Floyd Financial Group. We're always looking at what's going on with the market, what's going on with interest rates, what's going on with housing, what's going on with bonds, what's going on just in general with monetary supply. What's the dollar doing? What's it not doing? Who's getting tariffed and who's not, right now?
Right.
Who's blowing up who? We're always looking at all those things, but we have to make sure that we aren't being, and we've learned to back off from this, we're not emotionally making financial decisions. We're making them based on timing and fact. Now, I'm not saying we time the market, but what I am saying is, generally speaking, if interest rates are going up, it's not good for the stock markets. And generally, if the interest rates are going down, it's pretty good for the stock market. So there's a lot of things and a lot of indicators we can see. The thing we don't always know is the exact timing of how things are going to happen. We can pretty well know which direction things are going to go, but we don't know the exact timing.
So that is another myth that has been busted here on the radio version of Financial Mythbusters with Randy and Jake Floyd. I want to talk to our listeners here for just a moment, Randy. If anything that Randy and Jake said today hits a nerve, if you got yourself thinking, yeah, I believed one or two of those retirement myths, here's good news. You don't have to guess, because retirement isn't just about having a big number in an account. It's about knowing how to turn that money into reliable income, how to protect it when the markets get roughed, and how to avoid the quiet killers like taxes, inflation, and bad timing. And that's exactly why Randy and Jake here at Floyd Financial Group help families do this every single day. So call 417-889-7233, 417-889-7233. Ask for your Floyd Financial Group financial review at no cost and no obligation. You can also find out more about us online at floydfinancialgroup.com. Randy and Jake, let's take a break here on Show Me the Money. When we come back, we're going to be talking about common retirement investment misconceptions when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
We're back with your financial catch of the day, and it's a big one. Here's more Show Me the Money Radio with your hosts, Randy Floyd, Jake Floyd, and Jeff Shade.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money, and in this segment, we're going to be talking about common retirement and investment misconceptions.
And Randy, in the first half, we talked about retirement myths. Now I want to hit the money myths: annuities, bonds, real estate, Social Security, and of course, the big one, which is going to be withdrawal strategy. Why do retirees, Randy, get tripped up by investment products and rules of thumb?
Well, as Jake had alluded to earlier, everybody that's in the investment business, we all have something that we are selling and we're purporting that the client needs, right? So when we look at mutual funds, when we look at ETFs, when we look at annuities, we look at life insurance, IUL, variable, life insurance, term life, when we look at all those things, we have to make sure, while they all have a great use and a great purpose, we have to make sure that we're applying it to the right situation for each client as they come in the door. Because no two people are the same. As my grandma Maggard always said, it's like noses. Everybody's got one and they're all different. And that's kind of the way everybody is in their situation when they come in to retire.
I think the financial world that deals with retirements tries to sell simple answers. And it really isn't just one problem. It's multiple problems all at once. For example, income taxes, inflation, risk, and longevity. Most people overgeneralize, they chase certainty, and they avoid trade-offs. So let's go to myth number 2 here, if you will, or let's call it myth 1, actually. Annuities are a bad deal with high fees. What's your opinion on that one?
Yeah, so we have to look a little bit back at history. So if we look back in the 80s and 90s when variable annuities were actually a pretty new concept, during those times, if you remember, the 401k was new. People were learning to invest in it through the 80s and 90s. And so we had really rapid growth through those years. In fact, over a 15-year period there, we had some of the greatest growth we've ever seen. And so what happened was people were max funding their 401ks, max funding their IRAs, and people were saying, where can I place money right now where I can get market returns and not have to pay the taxes? Because we also had pretty high tax rates back through there, if you remember. So they were saying, I'll put it in one of these variable annuities and we can kick the tax football down the road and that'll be all right. So initially, they had a lot of pretty high fees on there. The investment fees were 1%, maybe 1.5%. They had this thing called mortality and expense. It was maybe another 1%. And so all of a sudden, these variable annuities were costing 3 and 4% to own. As time runs forward here and we look at some of these same products today and similar products, there's many different types of annuities. There's variable annuities, fixed index annuities. But here's what I will tell you. Many of these annuity contracts today have no fees or very low fees on them. So it's a much different environment than it was in the very beginning. And so it always takes people a while to catch on, right? So the IRA and 401k was formed in 1974 by the ERISA rule that was set up then. It took people to the mid-'80s to even realize that there was such a thing as a 401k, really. And so it's the same way here. We're having to re-educate people and the differences in how annuity contracts work today versus how they worked in the past. The old annuity everybody knew about was really expensive. And oh, by the way, once you set one of those up, your beneficiaries get nothing. And nothing is further from the truth today. Everybody has really worked diligently across the industry to make sure that annuities are fairly priced. They work to give us upside potential. Many of them can give us 100% downside risk protection. Some give us a little bit of a buffer. But there's many products out there that are very good. It's just really important to understand what you're doing and how to use those things to the best of your ability for each client and what their situation is.
So the right question isn't are annuities good or bad, but I think the better question is what problem am I trying to solve here and which annuity product might be the one to solve that. Okay, the other extreme, Randy, annuities guarantee income with no downside. Are annuities always the perfect solution?
No, they're not. I would say this, that in many cases for people that are risk averse, there are many really great annuity products out there to use today that can give us certain guarantees. The guarantees that are available are a guarantee of principal. The other things that are available, if they want a multi-year guaranteed interest rate annuity, they can get those, which it would definitely generate an income for them that way without any downside risk. Then there's other setups where we can have a lifetime income rider or benefit that says, hey, over your lifetime, we guarantee to pay you at least this amount. And nevertheless, even if your account balance goes to zero, we agree to continue to pay you. So there's a lot of ways to use these contracts. And it goes back, Jeff, and we've talked about this to the age-old question a lot of times is, would you rather have $1 million or $50,000 a year guaranteed for life? So depending on how people feel about that and what the emotion is attached to that question, different annuity contracts fill the bill for those different needs.
We're talking about retirement misconceptions here as far as investments go with Randy and Jake Floyd Financial Group. The next one is, I have substantial assets. Do I really need life insurance or long-term care coverage anymore? What do you think?
Well, that's a billion-dollar question right there. So there are people that say, right, you know what, I'm never going to a nursing home, so I don't even need to worry about that. Well, maybe. We don't know how that's all going to play out, and that's why we buy insurance for our car in case we have a wreck, right?
Mm-hmm.
We don't wait until we have a wreck and then go buy car insurance. You can't do it that way.
Yeah.
So what we have to look at, and there's a lot of people that are very successful that maybe don't need long-term care insurance. Everything has to be weighed out with cost and benefit, right? So if you have done very well and you just have more money than you think you can ever spend, and I'd be careful with that one, and you don't want to invest in long-term care insurance, that's up to you. And then the life insurance thing is the other way. And in today's world, we can also get life insurance that also will act as a long-term care policy, which is one of the things that sometimes that dual purpose works very well for. We even have some life insurance contracts today that will build cash value, provide income, provide long-term care, and a death benefit, whichever you need. So that's a really loaded question that we ask there. There's a lot of trade-offs, but I would say what it really boils down to is we really need to have a conversation with each individual client and talk through what it would mean if they needed long-term care. What if somebody dies early? How do we replace income for the remaining spouse? Those are all the questions that will lead people to a solid decision in these areas.
Right, and with car insurance, it's mandatory. You've got to have it. You cannot self-insure with car insurance, but there are ways to self-insure your life or with the nursing home, too. And I would encourage people to check out what a nursing home costs and what assisted living costs. If you think you can afford funding that, that's great. But I think most people listening to the program today, they're just not plumbed to do that. Okay, our next retirement investment misconception, Randy. Real estate is a guaranteed safe retirement investment. People love saying that real estate is safe. What do you think about that one?
Well, while, real estate is probably not going down in value, your home or rental properties or land, that sort of thing is probably going to go up in value. The problem is if you really need cash, you can't always just go get it.
Right. They're not liquid. You can't just trade it like the stock market.
That's right.
You can't bulldoze the front room on your house and have him cash it in for you.
Yeah.
Exactly.
If you're in the rental property business, that can be problematic because, you got insurance, you got taxes, you got bad tenants, you got people that won't pay their rent. There's just so many things that come into that. If you look at what the federal government would tell you, due to regulations, there's these things called real estate investment trusts, and most real estate investment trusts, the government says no more than 10% of the client's assets in one of those. Well, gee, I wonder why they would say that, because it's not very liquid, and sometimes they're completely illiquid unless you can find the next buyer for it. You can get a little income off there, but real estate is not the best income-producing asset. Rental property can work, and we have a lot of people that do that, but it's just something that really needs to be discussed, and whether you want to deal with it and be a landlord after the fact when you retire.
But you're right about real estate. It is not very liquid. And, when you get to be 70 years old, and I know that a lot of our listeners are retirement age, you just don't want to be an active landlord because it can be just a little bit too much. So there is another retirement investment misconception. The next one is I'm moving into bonds for safety. Bonds cannot lose money. I think I know the answer to that one, Jake and Randy, but go ahead, tell me.
Well, it's true. People say that bonds can't lose money, and that is just absolutely not true. Up and down value of a bond is directly related to interest rates. As interest rates rise, bonds get worth less, and if they're going down, bonds typically are worth a little bit more. But depending on what happens and when you need the liquidity, when you need the extra money, the timing of that may not be exactly right. While most bond funds and bond ETFs today are very diverse where you're not going to lose permanently a bunch of your money, you have to realize that the value of those bonds will go up and down, and the yield of those bonds may change as well. Which
can be a good thing. The purpose of bonds really for a long time in a 60-40 portfolio or just adding to the portfolio is it's a counterweight to stocks. If stocks really have a hard way, bonds tend to appreciate because generally you have falling interest rates in that environment. So it can be a hedge. Or like right now, if we're expecting interest rates to come down a couple of percent over the next 18 months, any bonds that you're holding there, they're going to increase in value. So it's a little bit like if we have a ceiling on interest rates to some extent, then we have the investment leaning in our favor. The opposite can also be true, though. So from 2010 to 2022, bonds paid very little interest, and we were kind of standing and dancing on the train tracks, daring the train to hit us. But now that it's the other way, I would say it's like shooting fish in a barrel, but we already talked about that earlier.
Right, we busted that myth completely. Talking with Randy and Jake, Floyd Financial Group, we're talking about retirement investment misconceptions here. The next one has to do with stocks. Randy and Jake, if someone owns stocks across many industries, are they automatically diversified?
Well, no. They might be allocated sufficiently, but diversification and the allocation are two different things. Allocation is how much am I really putting out toward, maybe if we would look at the 11 sectors of the S&P 500, from finance to basically oil and gas to utilities to consumer discretionary, consumer staples, all those sorts of things. There's 11 different segments. That's the allocation. The diversification then comes within the industry, and each industry we're talking about there. Being fully diversified isn't necessarily all it's cracked up to be. In other words, I don't want to be too diverse. I really want to be somewhat diverse, yes, but I want to be also picking companies that are on the uptrend and the best of breed within each of those allocations that I have. So I own many different industries. That's okay. That's probably a good thing. But all industries come in and out of favor. When we have one area of the market that gets really strong, like consumer staples here of late, because people are afraid, hitting new highs, and it was already in the stratosphere compared to where it used to run. Eventually, though, money will come back out of that, just like we saw money come out of the tech sector or the AI sector here just recently with this downturn that we had. So it's something that you got to be at the helm all the time and always watching. As we've talked about, things move too fast.
Let's move on now to our next retirement misconception. The 4% rule guarantees that I will not outlive my money.
Well, there's no guarantee for sure with that. If you retire at 60 and you put your money in your mattress at home and you spend 4% per year, in 25 years at 85, you're dead broke. So we can't really say that that is the truth. However, I will say this. If you're planning on spending 4% and you're moderately invested, you got somebody helping you do that, most likely you're not going to run out of money. Now, are you going to keep pace with inflation? Historically, yeah, maybe. But again, the 4% rule says that we start at 4 and then we adjust for inflation each year is really what the whole 4% rule talks about there.
All right. Another retirement investment misconception here is it's always best to use taxable accounts first and then let IRAs grow until RMD age.
I think there's some truth to that, but I would say that it's very case-by-case basis. So depending on how much IRA money you have versus how much non-qualified or after-tax money you have would definitely come into play. Your tax bracket is going to come into play there. When you retire, if you retire before 65 and you're on the Affordable Care Act, is going to come into play there. There's a lot of factors there, but I would say that especially if nursing home concerns you and liabilities concern you, if you have an irrevocable trust you put money into, you can't put IRA money in there. So if you spend the IRA money, you can put taxable money in there. Again, there's a lot of different things to consider there. I'd definitely say it's not as blanket as let IRAs grow to the highest possible and then take a maximum RMD. Now, there are situations where that does make sense, especially if you're very charitably minded. You can use that RMD for using what's called QCDs. That'll allow you to legally escape taxes on that over and above your standard deduction if you're taking a standard deduction. So there's a lot of things to consider there, but yeah, I wouldn't say it's that blanket for sure.
Talking about retirement misconceptions with Randy and Jake Floyd, Floyd Financial Group. Fantastic conversation because retirees don't need more options, guys. They need a plan that's built to last. If any of these misconceptions sound familiar to you, like annuities are always bad or bonds can't lose money, you're not alone. But here's the problem. Retirement doesn't punish people for not working hard. It punishes people for believing the wrong things. So if you want to set the record straight, call us here at Floyd Financial Group. Ask for your retirement review. No cost, no obligation. 417-889-7233 is our number. 417-889-7233. You can also find out more about us online at floydfinancialgroup.com. We'd love to talk to you. Randy and Jake, time for a break. We come back here on Show Me the Money. We're going to be talking about what a Floyd Financial Group retirement review actually looks like when our program continues here on 104.1 FM KSGF, where Springfield comes to talk.
People of the Ozarks, step away from the fishing pole and prepare to be shown the money, because we're back with more straight talk and honest answers with Randy Floyd, Jake Floyd, and Jeff Shea.
So, Randy, what does it look like when I come in to see you and Jake?
Right. And I think a lot of people hear me ask for them to call 417-889-7233 every week here in the program for that retirement review, but they do not know what it entails. So let's start there, Randy. Overview, what is it all about? What's the atmosphere like?
Yeah, so when you come in, a lot of people may or may not know this, but this office building we're in used to be years and years and years ago a farmhouse.
Really?
And then an attorney bought this building and put a second story on part of the building, and then put a big front entrance out there on the front of it. And then we purchased the building back in 2016 and kind of remodeled it to what we needed to be here. But again, it's kind of like a home setting in here, and it's very relaxed. It's not about putting a bright light in your face and grilling you, to find out.
Of course.
What we really want to do is just sit down and get to know people. And really what we want is to know what is important to people, what makes them tick, what their retirement looks like in their mind's eye, because everybody has a different take on that. And we just want to get to know them and what's important to them and make a friend, I guess, is really what it amounts to. That's what the first conversation is really about.
So it's really discovery, it's lifestyle planning, and I've heard many times, Randy, that in the beginning there that you'll sit down with people and you'll ask them questions, where they come from, and it's really just casual chit-chat. It's sort of like Grandma Mackard used to call visiting, right?
That's it. Yep. Come over and visit a while. That's basically what it amounts to. Yeah. So it's very relaxed, and you can ask us questions. Ask us about us. We're an open book.
Yeah, and because you've been there for a while, too, you know a lot of people in the community, and, they talk about their Uncle Herb, and you remember, oh, yeah, I remember him. He used to do oh, yeah, that was the guy. I did the boat upholstery for my cousin, things like that, too. So it really is just getting to know people. I think that's very, very important. You don't dive into product or anything else. So what do you suggest that someone bring with them when they come to this first appointment, or should they bring anything?
So I'll leave that up to them. Everybody's time is valuable, and I want to make sure that as we sit with people, we're using their time wisely. If they want, they can bring, of course, any investment statements that they have. If they're not of retirement age and they don't know what their Social Security is going to look like yet, at some point we will have to build a login and kind of get an estimate of that. If they've done that, they could bring that along. If not, it's something they can do later. Or they can just absolutely bring nothing. It's fine. We will be happy to talk with them. But again, from a productivity standpoint, any investment statements and things that they have would be nice for us to have, because we can really start then to develop a picture, if you will, kind of put the puzzle together.
So really it involves a 5-step process. We talked about discovery. What is the second, third, fourth, and fifth step here that people should expect?
So the second one is just kind of where we start to analyze everything and look at what we got from Social Security. Maybe if you have a pension, we'll look at that. We'll look at your 401ks. We'll look at what monies you may have saved that's taxable and what is not taxable. We may even have the conversation, because a lot of people want to talk about, should I convert my money to a Roth IRA from my traditional IRA? All those sorts of things will come up in the conversation. How much is Social Security going to be? Looking at a budget. Not that we're trying to put people on a budget as much as we just want you to know what you need to live on. And sometimes that's a little different than what my gross salary was. I mean, what am I actually bringing home? What am I actually spending? And that's where we kind of get through the analysis part of that.
All right, so discovery and analysis, then what happens next?
Third is Jake and I, once we kind of have a good idea of what people are looking for, then we go to the planning board, if you will, and we just sit down and start to look at everything and piece together what we think might be a good starting point to discuss with the client at the next meeting.
So that's the planning part of that. Now, is the client not there during the planning part? Really, it's not just one visit, is it?
Generally, it's going to be a couple of 3 visits is what it's going to end up being. It just depends on the individual. Sometimes we have people that come in, they said, hey, you helped my brother-in-law 7 years ago to retire. I'm just here. Tell me what to do. And then we have the other one that says, well, I've been listening to you on the radio for the last 8 years. In fact, we visited, you may not remember this, Randy, but we visited 7 years ago. And I said, you know what? I thought I remembered you. But anyway, we have a lot of that, too.
Sometimes we get some people that say that we've been listening to you for 15 years, and we haven't been doing it that long. So I know they're just trying to butter us up a little bit.
We'll take it. We'll take it. So discovery, analysis, then you've got your planning. The next is implementation. What is that all about?
Right. So once we've had the planning meeting and we kind of come to consensus on what makes sense, it's not that it's just our way or the highway. We want to have a good open conversation with our potential client or our next retiree and say, here's what we see. And generally they have a little bit of input and they say, well, we might want to do this or we might think about it this way. And we want to travel some early on or whatever. So there may be some tweaking that's done there. But once the plan is settled upon, then what we do is make it very easy for people to go ahead and implement the program. We will help them transfer 401ks if that's appropriate. We'll help them with their different investment options and set up their cash flow and help them get through all that process so that they are ready to retire. It's fun to watch this because sometimes we have people that come in, they're maybe age 60. Once they hit 65, they say, okay, that's it, I'm done, I'm retiring. Then they come in and we sit down, we set up their income streams and all that. But everything has to be done on the front end so we can get to that point and be ready when they're actually ready to pull the trigger.
Now, do you have to be actually ready to pull the trigger right now to come in for this review, or do you really work with people at different stages of retirement and maybe post-retirement?
Yeah, for sure. I mean, we work with people, really, we've got some people in their 40s and we got some even younger than that, but most people are probably between 50 and 80 years old that we deal with as a rule. And yes, you said post-retirees, people that have already retired sometimes want a second opinion. We do a lot of that type of work, but we have a lot of people that are just in their final 5 to 10 years of working, looking to kind of put the finishing touches, put the last bit of icing on the cake, and then put the sprinkles on so they can go retire.
All right. Now, when you look at what people have, do you find that sometimes people are actually better off than they thought? They just needed some clarity?
Yeah, we see that actually quite a lot. In fact, I know Jake had some people in here just not long ago, some people that we go to church with. At least I've been going to church with them for a decade.
Right.
And I asked this guy, I said, well, how'd it go with Jake? And he said, well, Jake says, I can retire right now. I said, well, what are you going to do? He says, I'm thinking about it. I said, well, what does that mean? He said, I'm about one bad day at work from doing it.
One bad day. Just try me.
Yeah.
I love that. You really do help a lot of people here. And again, I always say there is no cost. Truly, there isn't any cost to this, is there?
Just your time. I can't get you that back, but that's it.
All right. Certainly there's no cost for the planning part of this. So how do you actually get paid? Is that a question that people ask once in a while?
Sure. I mean, we are a fiduciary, and generally speaking, what ends up happening is we work basically for 1% of assets of money that's invested, which is probably on the lower end of cost for most people. Once in a while, there will be some products that are commissionable, but they generally do not ding the client's account for that payment. So generally, what people come in with is kind of what they start with, or maybe a little more.
And Randy, what do you say to those people who are listening right now and they think to themselves, I love these guys, they really know what they're talking about, but I don't have enough money to deal with Floyd Financial Group. Is that true?
I would say don't discount yourself. Give us a call. Let's sit down and have a chit-chat, and we'll see where we go from there. I mean, everybody has a starting point, and as my grandma always said, I know I talk about her a lot, but she said there's no big I's and little U's. We want people to be comfortable with us, and we want to be comfortable with them. We all want a good working relationship, and so we don't hear honestly, we don't hear no very often. We're pretty solid in the work that we do and the planning techniques that we use. We're not trying something new on you.
Right.
It's something we've been doing now. I mean, we're almost 26 years old, this company is now. So not our first rodeo.
Well, anyway, we had a great conversation here today. Once again, that number to call if you would like your Floyd Financial Group Retirement Review, 417-889-7233. Maybe you're listening to the program today. You're thinking, I really don't know if I'm ready for retirement. Well, you're not alone. As Randy said, some people come in and they don't know that they can retire. So many times you are the bearer of good news. That's exactly why Randy Floyd and Jake here and the team of Floyd Financial Group have created the Retirement Review to give you some good news. It's a step-by-step consultation that gives you some clarity and confidence. You're going to see where you are, whether or not you're on track, uncover hidden risks, stress test your income plan, and walk away with accountable next steps. No pressure, no guesswork. Once again, 417-889-7233. You can also find out more about us online at floydfinancialgroup.com. We're Randy and Jake. We're out of time for this week. I'm going to thank you for your time, but most importantly, I want to thank our fine listeners for joining us here in the last bastion of sanity, Springfield, Missouri. So for Randy and Jake, I'm Jeff Shade, wishing you a happy Valentine's Day and a great weekend. Be sure to join us again next week right here with another edition of Show Me the Money on 104.1 FM KSGF, where Springfield comes to talk. The information provided in the preceding program is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representations as to its completeness or accuracy. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Financial planning is offered through Floyd Financial Group, LLC, an SEC registered investment advisor.